Hello and welcome. Today, we're going to dive deep into something that's a fundamental part of the Canadian economy, the Goods and Services Tax, or GST, and its provincial partner, the Harmonized Sales Tax, or HST. You know, it's a tax we all see on our receipts almost every single day, but the way it actually works behind the scenes, well, that's a fascinating story of economic design and social policy. So, let's get into it.
We've got a clear roadmap for our discussion today. First, we'll cover the basics, what the GST/HST actually is. Then we'll unpack the core engine of the system, this idea of value added. After that, we'll see how different goods get treated differently, and then explore how the system tries to be fair to everyone. And finally, we'll look at the specific rules businesses need to follow.
So, at its very heart, the GST/HST is a national consumption tax. You might have also heard the term value-added tax, or VAT. That's what it's called in many other countries around the globe. And really, its job is to be applied to the vast majority of goods and services that are bought and sold right here in Canada.
Now, this system didn't just appear out of nowhere. For decades, Canada had something called the Federal Sales Tax, or FST, which was brought in way back in 1924. The biggest problem with the FST was that it created a tax-on-a-tax situation. It was hidden inside the price of goods, which made Canadian products more expensive and less competitive internationally. So in 1991, a massive change happened. The old FST was completely scrapped and replaced with the much more transparent 7% GST. A few years later, some provinces blended their sales tax with the GST to create the HST, and eventually the federal rate was lowered to the 5% we see today.
And that brings us to what things look like today. As you can see from this map, the tax rate you pay really depends on where you are in the country. Some provinces and all the territories, like Alberta and BC, just have that 5% federal GST. But others have harmonized, combining the 5% GST with the provincial portion to create a single HST, with rates from 13% all the way up to 15%. The real advantage of this harmonization is that it simplifies life for businesses. They only have to manage one tax system, which is handled by the federal government.
Okay, now for the really clever part. Let's dig into the core principle of the GST. It's a value-added tax. This is a really crucial distinction. Unlike a simple retail sales tax that just gets tacked on at the very end when you buy something, the GST is actually collected in stages, all the way through the production line.
So how does that actually work? Well, let's follow a wooden table on its journey. It starts at a lumber mill. They sell wood to a furniture maker and collect GST on that sale. Then the furniture maker uses that wood to build a beautiful table and sells it to a retailer, collecting GST on the table's new, higher value. And finally, the retailer sells the table to you, the consumer, and collects GST on the final price. But here's the magic trick, the key to the whole system. At every single one of those steps, the businesses get to reclaim the GST they paid on their own costs.
This recovery mechanism has a special name. It's called an Input Tax Credit, or ITC. Think of it as a refund. An ITC is a credit that registered businesses can claim to get back the GST/HST they paid on their business expenses. You know, the lumber, the tools, the electricity, you name it. So the furniture maker gets a credit for the tax they paid to the lumber mill, and the retailer gets a credit for the tax they paid to the furniture maker. This whole process ensures that the tax doesn't cascade or build up and become a hidden cost. It means the full weight of the tax is only ever paid by the final person in the chain, the consumer.
Now, a crucial part of making this whole system work is recognizing that not everything is taxed in the same way. In the world of GST/HST, everything falls into one of three buckets: taxable, zero-rated, or exempt. Most things are just plain taxable, but those other two categories are where things get really interesting from a policy perspective.
All right, let's put zero-rated and exempt supplies side by side, because the difference between them is absolutely fundamental. A zero-rated item is technically taxable, but the tax rate is, well, 0%. And because it's still technically in the system, the business selling it can claim input tax credits on all its costs. Now, an exempt supply is totally different. It's completely outside the GST system. No tax is charged to the customer. But, and this is the key part, the business cannot claim any ITCs for the tax it paid on its imports. That tax just becomes a cost of doing business.
So, what kinds of things are zero-rated? Well, the government uses this category for very specific reasons, mainly to make sure there's absolutely no hidden GST in the price of essential items. We're talking about things like basic groceries, milk, bread, vegetables, prescription drugs, and many medical devices. It also includes supplies for key industries like farming and fishing. And importantly, exports are zero-rated, which helps Canadian businesses compete fairly on the world stage.
And on the other side of the coin, we have exempt supplies. These are often services that the government has decided to keep outside the tax system, usually for social policy reasons or because they're just too complex to tax. This includes things many of us deal with regularly, like long-term residential rent, buying a used house, most health and dental services, childcare, and many financial services. Just remember, for all of these, the provider, your landlord, your dentist, can't claim ITCs, so the GST they pay on their own expenses is just baked into their costs.
This brings us to a really important question about the whole system: fairness. By their very nature, consumption taxes can hit lower-income households harder than wealthier ones. So how does Canada's system deal with that? It uses a very powerful tool called the GST credit.
So let's frame the problem here. Lower-income families tend to spend a much larger percentage of their income just on necessities, while higher-income families are able to save more. This means a flat tax on consumption can be regressive. In simple terms, it takes a bigger bite, percentage-wise, out of a smaller income. And you have to ask, is that really fair?
And you know what? The data confirms this. Just look at this chart. It shows the GST paid as a percentage of family income before any credits are applied. For families in the lowest 10% of incomes, the GST eats up about 3.8% of their disposable income. But for those in the highest 10%, it's only 2.1%. You can see that downward slope plain as day. It's regressive.
But now, watch what happens when we factor in the GST credit. The entire picture flips on its head. The system actually becomes progressive for the majority of families. In fact, look at that first bar. For the lowest income families, the effective tax rate becomes negative 1.7%. That's right, this means they actually receive more money back in GST credits than they pay in GST over the entire year. It's an incredibly powerful and targeted tool that completely reverses the regressive effect of the tax.
So the GST credit, which was introduced right from the start back in 1991, was designed specifically to solve this fairness problem. It's a tax-free payment sent out 4 times a year to individuals and families with low and modest incomes. Its job is to directly offset the consumption tax they pay, making the whole system much, much fairer. Okay, for our final section, let's switch gears a bit. Let's move from policy to practice and put on our business hats. We've established that businesses can recover the tax they pay, but how does that actually work on the ground? Well, as you can probably imagine, the process is governed by some very specific rules.
To claim an input tax credit, a business has to meet 3 key conditions. It's like a checklist. First, you have to be the legal recipient. The name on the invoice needs to be yours. Second, the things you bought must be for use in your commercial or taxable business activities. And third, and this one is a really big deal, you must have all the proper supporting paperwork.
And this table here lays out exactly what that paperwork needs to look like. You'll notice the rules get stricter as the price goes up. For smaller purchases up to $100, the basics like the supplier's name and the date are enough. But as soon as you cross that $100 mark, you absolutely must have the supplier's GST number. And once you're over $500, the requirements get even tighter, demanding your business's name as the recipient and a description of what you bought. The CRA is very meticulous about these details, so getting it right is crucial.
And this highlights a really critical point about due diligence. It's not enough to just see a registration number on an invoice. The responsibility falls squarely on the purchaser to make sure that their supplier's GST number is valid for every single transaction. Thankfully, the Canada Revenue Agency provides a free online registry to make this easier.
This quote really sums it all up quite nicely. The entire system is built on this principle of tax credits. It allows the tax to flow through the economy without getting stuck to businesses along the way, making sure it only becomes a final cost for the consumer. And it's all held together by a strict set of rules to make sure everyone is playing fair.
So when you look at the whole picture, we have a system designed for economic efficiency with the ITC mechanism, and at the same time, designed for social fairness with the GST credit. It truly is a constant balancing act, and as we look to the future, it leaves us with a really compelling question. What should be the next step, the next evolution in Canada's consumption tax policy to best serve both of these vital goals? Thank you for joining me.